folks, hope you all are doing well. I'm Karan Bandal from economists, your weekly wrap on economic news from India and around the world. So let's get started. 2022 economic growth for Germany surprises. Germany performed better than expected in 2022, growing at 1.9%. It grew at 2.6% in 2021. So, even though 2022 growth rate is lower, it comes as a positive surprise since the German government had predicted back in October 22 that the GDP would shrink by 0.4%. Of course, these predictions were made in light of extremely high energy price increases due to the war in Ukraine. As things progressed since October 22, the German government succeeded in building up its gas reserves aided by an unusually warm winter period. And they issued a substantial support package of $216 billion to soften the impact of high energy prices on consumers. As a result, it was the household final consumption expenditure that accounted for a large part of the growth of the German economy in 2022. So, government efforts surely have helped Germany outperform the expectations. Similar positive data surprises elsewhere are causing economists to become less gloomy. In recent weeks, a lot of surprisingly positive economic data has come out. Inflation, though high, is slowing in major parts of the world and downturn in activity is less severe than expected. Here's how. A British bank, Barclays, raised its global growth forecast for 2023 from 1.7 to 2.2%. This is largely driven by 1% increase in their growth prediction for China. They now predict China to grow by 4.8% owing to China scrapping its zero COVID policy and reopening. It also reflects 0.7% increase to Eurozone, meaning Eurozone is now expected to shrink by only 0.1% instead of a 0.6% contraction. This is because Germany has performed much better, as we discussed in the first story. Similar upgrades were made for US, Japan and UK. Barclays was not the only one to come up with upward revisions to its projections. German investment bank Berenberg and London-based TS Lombard did the same. Let's talk about interest rates in the Western world. Economic data in the US is getting better. Wage pressure is easing, which means inflation should ease as well. Inflation in the US has come down to 6.5% in December 22, but it is still well above Fed's target of 2%. So, central bank will continue its fight against inflation. Barclays expects US Fed to continue raising rates to a terminal rate of 5.25% by May 2023 and stay there. Similarly, core inflation in the Eurozone has remained sticky. So, Barclays suggests the ECB, that is European Central Bank, will continue rate hikes to bring European terminal rate at 3% and keep it there. In the UK as well, inflation has remained persistent. Labour market also remains tight. Barclays expects Bank of England to continue with the rate hikes here, taking terminal rate to 4.5% and keep it there. So, what do these rate expectations mean? These are historically high interest rates since the great financial crisis of 2008, and the fact that economists expect rates to go this high, they seem confident in the ability of economies of these countries to handle high rates without slipping into recession. Continuing on the theme of surprisingly positive economic data, let's look at China. China reports 3% GDP growth. China achieved better than expected growth in 2022. Its GDP grew by 3%. This is lower than the official target of around 5.5%, but considering major parts of China were in lockdown courtesy zero COVID policy for the most part of 2022, 3% is a positive surprise. China is one of the few countries that has not shrunk throughout the COVID pandemic, at least according to the Chinese official data. Even though China is now reopening, damage to business sentiment in China caused by the zero COVID policy may be irreversible. US-China trade tensions also play a role here. Let's talk about it. European firms look to Vietnam and India. Recently, two surveys came out. One from the European Chamber of Commerce in Vietnam. They polled more than 200 European companies, and the other from Container Exchange. This is a German online container logistics platform. and they polled 2,600 candidates from over 20 countries. Both surveys point to a common trend. For the past 3 years, Beijing did not relent on its hardline zero COVID policy. This led to a sporadic and stringent lockdown in China, affecting many foreign companies operating in China. These companies could not get their hands on raw material or finished product coming out of China. As a result, they had to suffer heavy financial costs. And this has been going on for 3 long years. Now, these firms are looking for stable business and investment conditions elsewhere. The surveys indicate the share of European companies that have relocated some of their operations from China to Vietnam rose to 41% in the last quarter of 2022. This was only 13% in the third quarter of the same year. 67% of the respondents said they were considering alternatives for production and manufacturing after China's zero COVID restrictions. Vietnam and India are considered the most attractive destinations. China has established itself as a manufacturing powerhouse in the last 40 years and its importance will remain. But other power centers will come up around China in the future. Container Exchange says we will witness a gradual shift from industries relying solely on China for production capacity and skilled manpower. In the near term, Vietnam and India will rise as functioning container shipping hubs in 2023 and change the existing layout of the global shipping industry. Our final story reinforces this exact point. Apple gets a boost in India. We know that iPhone exports from India have skyrocketed last year, and yet 98% of all iPhones sold globally are still made in China. It appears that Apple wants to speed up its supply chain diversification efforts by expanding operations in India. The limiting factor, however, is the absence of crucial component makers close to the final assembly plants. So, Apple submitted a list of around 17 suppliers to the Indian authorities seeking their entry into India. Now, these are Chinese companies, and due to the recent border clashes between India and China, Chinese companies cannot set up operations in India freely. Well, in this case, more than a dozen of these suppliers received initial clearance by the Indian authorities. This comes as a boost for Apple as it gets one step closer to significantly expand its manufacturing presence in India. India also wants to expand electronic components manufacturing ecosystem domestically, and joint ventures with established Chinese companies is one way of doing that. Of course, after vetting them thoroughly for any direct ties with the Chinese government. So, Germany did better than expected, China grew more than expected, inflation is slowing globally, and global growth forecast is revised upwards. So, a bunch of positive developments this week. But keep in mind, even though revised upwards, a global growth forecast of 2.2% is still anemic. An anemic global growth from India's perspective does not help. It will drag down India's exports. But India may continue to benefit from friendshoring, that is, predominantly Western firms shifting part of their manufacturing base from China to a friendly country like India. I hope you found this week's wrap interesting. I will speak with you again next week. Until then, take care.